Here's something that confuses a lot of NRIs. The news says growth is slowing, inflation is a concern, and then there are geopolitical tensions everywhere. And yet, your stock market continues to hit new highs. So naturally, people are asking this genuine question: how can my portfolio continues to grow when the economy feels absolutely battered? And that's exactly what I'm going to explain today. By the end of this video, you'll understand why the stock market can rise even when the economic growth slows, why this matters if you live abroad, and how I think NRIs should position their portfolio in 2026 and beyond. Make sure you stay till the end, because this understanding can completely change how you invest. Hi, I'm Will. I've been living in the UK as an NRI for the last 15 years. And in my previous role, I worked with professional financial platforms such as DataStream, Thomson One Analytics, and WorldScope, helping analyze market and company data used by the investment professionals. Today, I want to break this down in plain English. And if you're an NRI or an expat trying to build wealth across the countries, consider subscribing, because that's exactly what this channel is about. First thing, as an investor, you'll have to understand is this: the stock market is not the economy. They're related in some sense, but they're not the same thing. Like, for example, the economy measures things such as GDP growth, the employment, and how, as a consumer, you're spending your money. Whereas in the stock market, this is basically measuring the value of an investor placing on a future performance of a company. The word is future, and that is the most critical aspect that you need to understand as an investor. Markets are always looking ahead. If an investor believes that a company will continue to grow and make profits over the next 5 to 10 years, naturally, that stock prices can rise even if the current economic headlines will continue to look bleak. For example, if your salary is temporarily flat, but you're expecting a strong promotion over the next few years, your long-term financial outlook is still positive. And that's how the market thinks. The second reason is inflation. Now, this might sound actually counterintuitive, but listen me out. Many of the strong businesses can raise their prices over time. For example, if a company sells a product for $100 this year and $110 next year, that small increase will increase the revenue even if the number of products sold by that company is the same. And over time, higher revenues can lead to higher profits. And because stock prices are linked to the expected profits of a company, they often raise over time. This is one of the main reasons why the equities historically outpace the inflation. As investors often discuss in communities like Reddit, owning broad equity funds means owning companies that can adjust prices and continue to generate profits over time. Here's the interesting part. Many of the world's largest companies do not actually depend on one country alone. Take, for example, companies listed in the S&P 500. A significant portion of shares of their revenue comes from outside of the United States. That means growth in India, Asia, or Europe can all support corporate profits. So even if one economy slows, large multinationals like Apple, Nvidia, all of these companies can continue to perform really well. This is why global diversification is an absolute game changer and a powerful allocation that you can have in your portfolio. And when you invest it in world funds such as the FTSE All World or Total Stock Index, you own thousands of companies across the developed market and emerging markets. And here's the thing that you need to consider as an investor. Markets actually don't wait for the economy to improve. They often move when the investor believes that the conditions for a particular company will improve in the future. Let's take, for example, if interest rates are predicted to fall in the next year, markets may rise today. So it'll react to something that might potentially happen tomorrow today. And if profits are expected to recover, stock prices often adjust before the good news becomes even obvious. That's why the markets can actually feel completely disconnected from everyday headlines. And that's the key aspect. Markets are always looking ahead instead of looking backwards. And why this is one of the most crucial important thing for an NRI. And this matters enormously for us. Many people actually assume that they need to choose just one country and start investing. And as an NRI, we are all guilty of completely depending on India's performance. And that's why most of the people actually send bulk of their money and invest it in India. And some people stick to just the United States, but that often is the wrong way to think. The better approach is to own a globally diversified portfolio. That way, you will benefit from the growth no matter where it's happening, and you're also going to reduce your concentration risk. And finally, you avoid depending on one economy growth or one currency's dependence. And here's the simple framework many NRIs should consider. And if you're going to be a long-term investor, set aside 60 to 75% and set it aside as a global core. And you need to hold this in a tax-efficient account. For people who are living here in the UK, you've got the stocks and shares ISA account or your SIP account. For people who live in the US, a Roth IRA account or a 401k account could be beneficial for you to get tax-free returns, and invest that money into core fund, which could include the Vanguard FTSE All World or the Vanguard Total World Stock ETF. The next 20 to 30%, put it aside towards India allocation. You can pick an ETF which primarily focus on India, like the MSCI India ETF, or you can send your money into your NRE account and invest it into a mutual fund. You use the second option when you have completely exhausted your tax-free allowances in your current country. The next 5 to 15% will become your stability. This is where you can set aside money into cash, where you can put it aside into a high yield savings account, which will give you steady interest rate. Make sure it is beating the inflation that's currently in your country. Or you can set it aside some money into bonds and pension funds as well. This approach will allow you to participate in India's long-term growth while your majority of your portfolio is well diversified globally. That way you're not linked to a single market risk. The biggest advantage of this approach isn't just the return, it's the resilience that you have built in your portfolio. If one country actually struggles, let's say for India, the rest of your portfolio continues working. And that peace of mind is an absolute game changer. And as an investor, you want to be in that position to be able to make that valued decision and reap benefit out of that. So yes, stocks can rise even when the economy feels sluggish. And that's because primarily companies can raise prices over time and global businesses can earn revenue from many countries. And finally, markets always look ahead for future profits. And for NRIs and expats, the lesson is quite simple. Don't rely on one country to build your future. Build a portfolio that can benefit from growth no matter where it is happening. The key takeaway for you is you're not betting on one single country to actually perform really well and make maximum return. You're globally diversified. Your goal is to own great businesses from around the world to maximize your returns. And that way you're protecting it from any volatility. And finally, a quick question. Where is most of your money invested right now? Is it in India, UK, US, or have you mixed it up globally? Leave your comment below. I read every single one of them. And if you like this video, please consider subscribing and hit that notification bell as well to get notified every time a new video is dropped. And in the next video, I will share with you the exact allocation of my portfolio, including the ETFs that I currently use and also their exact allocation. And if you're interested to know that, hit that subscribe button as well. And if you're still around, I really appreciate you watching the entire video. And please subscribe to the channel so you get notified of any new videos that I drop. Thank you again, and I'll catch you in the next one.